Welcome to Business Insights. Today we're diving into the intriguing world of Uber and the hidden costs behind its rapid growth. While Uber's innovative model has disrupted the transportation industry, there's more beneath the surface than meets the eye. We're here to examine the role of investor money and subsidies in Uber's business model, discussing the sustainability of these practices and their impact on long-term profitability. Uber's meteoric rise can be attributed to substantial investments from venture capitalists and institutional investors. Since its inception, Uber has raised billions of dollars, allowing it to scale rapidly and expand globally. This influx of capital has been crucial for Uber to gain a foothold in various markets, often using aggressive strategies to outcompete traditional taxis. A key part of Uber's strategy has been subsidies and incentives. To attract drivers and passengers, Uber has relied heavily on financial incentives. For drivers, this has meant substantial bonuses and guaranteed earnings, compensating for the initial lack of passenger demand. For passengers, Uber has offered discounted fares and promotional deals, making it an attractive alternative to traditional taxis. However, these subsidies come at a cost. Despite impressive revenue growth, Uber has struggled to achieve profitability. High operating costs, including driver incentives, marketing and regulatory compliance, have contributed to significant financial losses. In 2019, Uber reported a net loss of $8.5 billion, highlighting the immense financial pressure of maintaining these subsidies. Let's consider the sustainability of this model. While investor money has enabled Uber to sustain its operations, the reliance on continuous investment is not viable in the long term. As investor pressure mounts for Uber to achieve profitability, the company has had to implement cost-cutting measures, including layoffs, office closures, and scaling back unprofitable operations. These measures indicate a shift towards a more sustainable approach, but the path to profitability remains challenging. Uber's growth has also been aided by subsidies that make their rides appear cheaper and more efficient. However, this efficiency is often an illusion. Traditional taxis, with their shift-based operations, centralized maintenance and fleet management, still outperform Uber in several ways. Taxis run on a shift system, maximizing vehicle availability and minimizing downtime. This means fewer vehicles are needed to provide the same volume of service, reducing overall costs. In-house mechanics and bulk purchasing of parts further enhance the efficiency of taxi services. This greater scale and efficiency mean that despite the appeal of Uber's flexible model, taxis remain more cost-effective in the long run. Financial analysts and industry experts have voiced concerns about Uber's long-term viability. The heavy reliance on subsidies to attract drivers and passengers distorts the actual cost of providing ride-hailing services. Research by the Economic Policy Institute found that, after expenses, Uber drivers earn an average of $9.21 per hour, significantly less than advertised rates and below many traditional taxi drivers' earnings. This highlights the unsustainable nature of Uber's subsidy-driven growth. In conclusion, while Uber has revolutionized the transportation industry, its growth has been heavily subsidized by investor money, raising questions about long-term sustainability. The hidden costs of these subsidies, coupled with high operating expenses and environmental concerns, challenge the notion of Uber's efficiency. Traditional taxis, with their operational efficiencies and scale, remain a more sustainable option in many respects. What do you think? Can Uber overcome these challenges and achieve long-term profitability, or will traditional taxis continue to hold their ground? Let us know in the comments below. If you enjoyed this video, please like, share, and subscribe to Business Insights for more in-depth analysis on the latest business trends. Thanks for watching.